Have you ever wondered how corporations are taxed in Canada? Whether you're a seasoned business owner, a budding entrepreneur, or a curious investor, understanding the ins and outs of corporate taxation is important for your financial success. Today, we'll dive into corporate taxes in Canada. We'll examine the differences between active and passive income, federal and provincial tax rates, and the decisions that can shape the future of your business. I'm Gregory Rostiba, the founder and CEO of Dundas Life, a leading life insurance brokerage in Canada. At Dundas Life, we're not just about insurance, we're about empowering you to secure your financial future. We've guided hundreds of Canadian business owners through the maze of finance and taxation, and today, we'll be your trusted guide. So let's get started. To begin, let's define a corporation as seen by the government. A corporation is a type of business structure that is considered a separate legal entity from its owners, who are known as the shareholders. This means that the corporation has its own legal rights and responsibilities, just like a person. It can enter into contracts, incur debt, and pay taxes separately from its owners. One of the main advantages of a corporation is what's known as limited liability. This means that the shareholders of the corporation are not personally responsible for the corporation's debts. If the corporation goes bankrupt or is sued, the shareholders' assets, like their homes or cars, are usually safe. They can only lose up to the amount they invested in the corporation. However, this separation also means that corporations have tax obligations. They must file their tax returns and pay taxes on their profits. These tax rules can be complex and vary depending on the location and size of the corporation, which is why many corporations hire tax professionals to help them navigate these rules. Corporations in Canada have to pay two types of taxes: federal tax and provincial tax. The federal tax rate is a flat rate, currently set at 15%. But here's where it gets interesting. Provincial tax rates vary depending on the province where the corporation is based. For example, in Ontario, the provincial tax rate currently hovers around 13.16% for income over $220,000, while Alberta has a rate of 15% for an income over $312,171. Now let's discuss a principle that governs how corporations are taxed in Canada. This is known as integration. Integration is like a fairness rule in Canada's tax system. It's there to make sure that people pay roughly the same amount of tax whether they earn money directly or through a business they own. Here's a simple way to understand it. Imagine a business makes some money. That money is taxed, and what's left is the business's profit. If the business then gives this profit to the owners as dividends, the owner also has to pay tax on it. Without integration, this would be like paying tax twice on the same money, once for the business and once for the owner. To avoid double taxation, Canada's tax system gives a special tax break to people who get dividends. This tax break is meant to balance out the tax that the business already paid. The overall tax paid is about the same if the owners had earned income directly. But what about small businesses? Well, they are eligible for a small business deduction. This lets small businesses pay a lower tax rate on part of their income. To get this, a business must be a Canadian-controlled private corporation, or a CCPC, make taxable income from an active business in Canada, and not make more than a certain amount each year, currently up to $500,000 in business income. Next, let's look at active and passive income tax rates. Active business income is the money you make from your regular operations. If you run a store, it's money you make from selling your products. In Ontario, the tax rate for active business income is 11.5%. Passive income is a bit different. It's the money your corporation makes from interest, dividends, or capital gains on investment. It's usually taxed at a higher rate as it's part of the integration rule, which helps maintain a balance between people making passive income and active income. In Ontario, the tax rate on passive investments in a business is 50%, but some of the taxes paid on investment income can be given back when the business gives the income as dividends to the owners. Now let's shift our focus to paying yourself from your corporation. As a business owner, you have a couple of options: taking a salary or receiving a dividend. Both have their pros and cons. A salary provides a consistent income, allowing you to contribute to your registered retirement savings plan and enjoy the benefits of stable cash flow. On the other hand, dividends are taxed at a lower rate due to the dividend tax credit. Before you decide to create a business or incorporate it, it's important to consider a few potential challenges. While forming a corporation can offer benefits like limited liability and tax advantages, it also means more administrative work. You'll have to deal with extra paperwork, follow more rules, and you might need to hire professionals to help you. Another thing to think about is how to handle business losses. If you're self-employed, losses can lower your taxes, but with a corporation, it's a bit more complex. There might be limits to make it hard to use losses to lower your tax bill. And remember, using business assets for personal reasons can lead to more taxes and complications. For example, if you use a company car for personal trips, it can lead to taxable benefits that need to be reported on your tax returns. This could increase your tax bill. So it's important to be careful and follow the rules. Understanding how corporations are taxed is essential for running a successful business. With the right guidance and knowledge of an experienced Dundas Life advisor, you can navigate the intricacies of corporate taxation with confidence. Reach out to us for help today. Thank you for watching our video on corporate taxes in Canada. If you liked it, please hit the like button and subscribe to our Dundas Life channel for more. Stay safe, keep learning, and see you on the next one.